Hello, everyone, and welcome to this panel A of the Green Swan Conference on the topic of biodiversity loss, its implications for socioeconomic and financial systems, and the potential solutions to revert the current situation, with a focus, of course, on the financial sector, given the conference. I'm just mentioning, since we had a few technical glitches, if there's anything, Sebastian, please let me know. Otherwise, I will continue. So I'm very pleased and honored to moderate this panel in the presence of no less than 6 very distinguished speakers, who I will briefly present as I ask them questions. But if interested, you can also find their longer bios on the website of the conference. And I shall say special thanks to Jim O'Neill, who had a little health intervention, but was able to join us today. So thanks a lot for that. Given that we have 6 speakers and that we want to have to save some time for a Q&A at the end, I will only ask 1 question to each speaker, and we'll give them between 7 and 8 minutes to answer. And I will be playing a little bit some sort of the bad cop there, and let you know when you have less than a minute to answer, if I feel that you're still far from the end of your response. The way I would like to proceed for this panel with my question is in 3 steps. First, we will take advantage of Elizabeth Mrema's presence today to get an overview of why biodiversity loss is possibly as concerning and critical to our socioeconomic and financial systems as climate change, although it has been much less discussed than climate change in policy arena, media, civil society, and so on. But this is thankfully, hope this is rapidly changing, thankfully. Elizabeth Mrema serves as the Executive Secretary of the UN Convention on Biological Diversity, CBD. So we could hardly think of a more distinguished speaker to remind us of the issues at stake, and perhaps also raise some awareness among the audience. Second, I will ask 3 speakers with a strong financial background to focus on the financial risk dimension of biodiversity loss, so that they can explain what are the challenges related to the assessment of this risk and what kind of solution they suggest to address them. And third, I will ask my last 2 speakers to reflect on these proposals made by the previous speakers in the context of broader institutional changes. Basically, the idea is that it's hard to conceive that financial players can solve the question of biodiversity on their own. So the question is really about how their actions should be embedded within broader transformative changes, to use the language of the IPBES. And finally, this is not really a 4th step, but I would like to ask Elizabeth Mrema to reflect very briefly on what will have been said by the other speakers, and to see how these reflections somehow fit within the COP15 on biodiversity that will take place in China in October, and which should explicitly touch upon the role of the financial sector. And one last logistical detail before we start. So all the attendants can ask their questions in the chat while the panelists speak. I would just say that if your question is addressed to a specific panelist, please try to make sure to mention it at the beginning of your question, to make it easier for me, since I will be both listening and reading your question. And I'll do my best to ensure that all your questions are addressed, but I may have to skip some of them, or at least to merge some of them, to make sure that we address as many as possible. So without further ado, let me start with you, Elizabeth, if it's fine to call you by your first name. As I mentioned, I think it's very important to start this panel with an overview of why biodiversity loss is such a critical issue, since this is not completely obvious for many people yet, compared with climate change. So could you tell us, in your capacity as Executive Secretary to the CBD, why biodiversity loss is so important for socioeconomic systems, and why the international agenda may lead to a very important decision in this respect, I would say, in the short to medium term?
Thank you very much. Can you hear me?
Yes, we can.
Thank you. Let me begin with the greetings. Good morning, good afternoon, good evening, wherever we are, ladies and gentlemen. I'd like first to thank the Green Swan Conference and the Banque de France for the opportunity given to me to talk to this conference from the perspective of the Convention on Biological Diversity. And I will begin. The science has given us an unequivocal evidence, and is very clear. Clear in the sense that in terms of species loss, land degradation, deforestation, ecosystem loss, invasive alien species, impacts of chemicals, climate change, scientists and economists are giving us consistent message that we are unfortunately undermining nature beyond sustainable limits, and the consequences for local communities, societies at large, and our global economy are massive. Why am I saying so? One, according to the 2019 IPBS report, IPBS Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services, indicated 1/4 of species are threatened, and around 1 million species already face extinction within this century, with the majority of ecosystems and biodiversity indicators already in decline. Indeed, now we know that economic sectors and ourselves, the people, rely on nature and on services that the ecosystems provide for free. For example, food, water purification, air quality, carbon sequestration, soil stabilization, coastal protection, recreation, cultural values, among others. Two, the Swiss reinsurance reached equally a similar conclusion to the World Economic Forum in its biodiversity and ecosystem services assessment produced last year, 2020, which says 50% of the global domestic products, GDP, depends on high-functioning biodiversity and ecosystem services, and thus moderately or highly dependent on nature. Furthermore, our current global health crisis has even raised further awareness to the urgency of protecting biodiversity. So we need more ambitious policies at all levels. How will we achieve this ambition? In October, as we have mentioned, at our Conference of the Parties 15 to be held in China, our 196 parties to the convention are expected to adopt a universal, ambitious, and transformative post-2020 global biodiversity framework. Just as the Paris Agreement on Climate, the post-2020 framework aims to mobilize the world to protect and restore nature, combat climate change, achieve sustainable development goals, including ability to provide jobs, growth, and economic prosperity. Implementation of this framework will require an unprecedented mobilization of financial resources from all sources to close the financial gap on biodiversity. It also requires the development of capacities at all levels and mainstreaming biodiversity in economic sectors to align financial flows with the biodiversity issues. It will require the involvement of the public. Involvement of all public and private sectors, including the financial sector. So financial institutions, through their corporate social responsibility, could actually consider setting up or setting aside some seed capital resources, which others could match to support your role, their role in the implementation of this upcoming framework. The framework will be translated into actions, policies, and regulations at regional and national levels that will have direct consequences on the operations of the companies and financial entities. The financial community has a critical leveraging role to pivot economic sectors towards more positive impacts on nature. The call for the financial community to act will become even louder as the world strengthens its nature goals and builds new techniques to measure nature laws. Why is biodiversity loss then so important for the financial sector? The loss of biodiversity needs to be understood by the financial sector as a financial risk through the physical risks, transition risks, via compliance demands, as well as reputational risk. It needs to be understood as both an ecological and economic emergency, compounding the climate crisis that challenges the very foundations of life on nature. That is what the Dutch Central Bank highlighted by concluding that a third of the assets of all Dutch banks are exposed to biodiversity loss, actually saying about 510 billion euros, or 36% of its total assets. Furthermore, businesses that the financial sector finance or invest in or insure depends on nature and the safe climate. They rely on the health and abundance found in our oceans, on land, and on forests for the supply chain and raw materials, and for solutions to the development challenges. Finance for Biodiversity, the UK think tank, estimated that more than a quarter of all development financial institutions' collective balance sheet, about $3.1 trillion, is also highly dependent on nature. Clearly, biodiversity also presents a sustainable finance opportunity for the development of new financial products and offering in what is estimated to be a multi-trillion-dollar market over the coming decades. These developments require adequate enabling environment and appropriate governmental policies, regulations, and incentives, as well as development of adequate financial mechanisms that will reduce financial risks, provide returns, and promote positive impacts on biodiversity. These are some of the issues which will be discussed during a workshop with the financial sector that we at the Secretariat are organizing to take place on 17th and 18th June. It will be one of the key steps for the success of our Conference of the Parties 15. It will allow the financial actors and the CBD community to build that mutual understanding between the global financial sector, both private and public, and the convention community on the basis of a stronger collaboration on the role of finance in the development and implementation of the framework. Lastly, what could be the role then of the central banks and the regulators? I'm pleased that today we will be discussing on how to put nature to work to build greater resilience in the financial sector. We certainly need the engagement of the central banks and the regulators. Climate change is increasingly recognized as generating systemic risks for country debt portfolios and credit ratings, and the same is happening in the biodiversity field. It is in the country's best long-term interest to reflect these risks in their macro prudential policies and rules. In these critical...
I will have to, if you could conclude in one or two sentences, otherwise I will give you the opportunity to reflect on that at the end.
I believe the central banks and other regulators can be strategic allies for implementing biodiversity policies. You have a key role to play in assessing economic risks of transitioning economic sectors to a more sustainable pathways and mitigating these risks by acting on the causes in a systematic manner, in requiring disclosure of nature-related risks and opportunities, for instance, being engaged in the task force on nature-related financial disclosures or other approaches. Thank you very much.
Thank you very much, Elizabeth, and sorry for interrupting you. I just wanted to to be sure that I could be mean with my
Yes.
other speakers if they go ahead the other time. So I think that with this background, and thank you very much for this very enlightening overview, which really sets the tone for the rest of this panel. And I would like to proceed to the second step, where I would like to ask three of the speakers to reflect on two questions. First, how do they think that financial risks posed by biodiversity loss, which Elizabeth just mentioned, how should this risk be approached by financial players? And second, since this conference wants to focus as much as possible on solutions, what do you see as the most important actions or solutions to be implemented by central banks, financial regulators, financial supervisors? So I will start with Torsten Thiele, who's a visiting fellow at the London School of Economics, LSE. Torsten, how do you see this question of biodiversity loss from a financial perspective? What do you think the financial sector should do about it? And in particular, given that you founded the Global Ocean Trust and that much of your work has been on ocean governance and marine conservation, do you think you could relate that a little bit as well to your own experience and expertise?
Thank you very much indeed. Yes, biodiversity collapse, species extinction, destruction of habitats, this is a massive critical issue right now and has multiple links to finance. It has links to financial flows that are encouraging destruction that need to be redirected. It has specific impacts on certain sectors. The regulatory environment matters. And so we have used this language of risks and tipping points, really taken from ecology to the financial system, to find pathways that shift towards nature positive approaches. And that switch is particularly important because the climate crisis and the biodiversity crisis are not just additional, but they are also different. And they need different approaches to take this forward. And this isn't just about the key physical risks. It's very much the transition, but also the liability risks that can come very rapidly to those players that are directly or indirectly impacting biodiversity. And the tipping point idea is very much to keep in mind the time frames that we are talking about in nature. The last time you and an intelligent octopus had something in common was 750 million years ago. We're talking about a completely different way of looking at time than we do in the climate world. And so it is indeed crucial that we have appropriate analysis and screening of nature risks, that we understand supply chains in detail so that we can disclose what these impacts are, that our taxonomies reflect impact metrics and help all of us to redirect flows in a way that we have systemic benefits and economic returns. And this is, as I say, crucial in the climate context because some of the climate transition pathways in themselves have limitations that require an integrated design. So for instance, scaling up bioenergy has an impact on biodiversity. Large infrastructure projects can have an impact on biodiversity. So I will apply now all this thinking of tipping points and risk to the ocean, which is of course the largest livable space on the planet, over 90%. It's where almost half of our economies come from and are related to. And so major livelihoods, exposure to what happens in the ocean, exposure to real estate, to infrastructure. But of course, the system itself, the complexity of the ocean system, which had the longest time to evolve, is at risk here. And I will take three specific examples. So if we talk about, say, a coastal ecosystem with its coral reefs, its seagrasses, its mangroves, this is a critical habitat for fish biodiversity, for local livelihoods, it attracts tourism, it protects this physical, nature-based solution, protects that ecosystem. So if we now have a collapse of coral reefs as a result of direct action, whether it's overfishing or other activities, or indirectly as a result of global warming, that entire system can collapse. And so take a small island state that has to deal with this change. All its various sectors that depend on this ocean and coastal nature are at risk. And we already heard from Elizabeth Mrema the challenge then of over-indebtedness that comes with the attempt to try to solve this critical problem. And this is a risk that is right now being faced by a whole range of coastal communities. Or if we go into parts of the ocean, say the Mediterranean or the Baltic Sea or the Gulf of Mexico, where we have hundreds of thousands of square kilometers of dead zones because deoxynation has led to already a collapse of a complex marine ecosystem. So we are now in a space where it isn't any longer about trying to recover fisheries. It's first and foremost about giving nature a chance to even come back. Or if we think even more broadly, if we think about how the ocean currents work and the ocean microbiome works and the phytoplankton that helps in the carbon recycling and the high seas for which we have no governance regime, we're still at the early stage of discussion. So all of these areas are at risk and show that at different scales, this biodiversity risk needs immediate addressing. And that addressing on the financial side means obviously direct regulatory action, but also a whole range of mechanisms that we can use to change incentives. So valuation, ocean assets accounting, markets for natural capital, the development of an asset class for long-term patient capital to come into the space. All of this is critically dependent on the right financially regulation system. And the example I want to use is a concept that we call blue natural capital. Because blue natural capital is really about saying there are clear, discrete natural capital assets in that space that if we regulate, identify, define them appropriately, deliver an investment process, a capacity to help nature help itself. And I will take two examples. One is around blue carbon. There, of course, already understanding.
Less than a minute left, I think. So if you could go very briefly. Yeah.
So I have two examples. One is blue carbon. This is the mitigation capacity that mangroves and seagrasses have. But they have, of course, much more capacity. They provide a resilience, adaptation, livelihoods, and biodiversity protection. And that value we need to capture. And very importantly, we need to integrate those nature-based solutions in infrastructure. So only blue infrastructure that is fully nature tested and maximizes the use of nature, will allow for the large expenditure that we do on infrastructure to be consistent with biodiversity. So we need that biodiversity testing to develop a blue natural capital asset class. Thank you.
Thank you very much, Torsten, and thank you for sticking to your time there. I will now ask Dirk Schoenmaker, who's a professor at the Rotterdam School of Management, Erasmus University, to reflect on the points that were made by Torsten, and perhaps with a stronger focus on central banks and financial regulators, supervisors, given your own work, your own expertise. Over to you with this easy question: how should central banks and financial supervisors should think about this? What should they do about this risk?
Yeah, thank you, Romain, and great to be on this panel. And I think for everybody who's choosing this panel, it is already clear that biodiversity is as important as climate change. And we all know how much financial capital has increased over the last years. Even if you take it in proportion to GDP, financial capital has been risen 150%, whether you take bank assets to GDP or stocks or equities. Well, natural capital, the Living Planet Index, we all know it from the World Wildlife Fund, has declined 68% over the last 50 years, and it keeps on declining. And I think it is time that we swap places. Now nature is supporting financial accumulation, and how can we use finance to support nature? I think really swapping places. And let me say how we can do it, I think. The first one is, as central bankers, regulators, finance people, we are all trained on the risk side. So the big thing all the time is financial stability, green swan. I will say a little bit about it, but I think if we really want to swap places, we have to start about opportunities. And I like the blue asset class. I will have the same for land restoration. We need to change our thinking from risk to starting to restore, because otherwise we keep on talking about risk and worrying, and it is far more exciting to be on the positive side. On the risk, you see many different ways of measuring biodiversity, and I think Elizabeth made it extremely clear that biodiversity is extremely complex, interwoven with many mechanisms, tipping points. Torsten also mentioned them. We can lose ourselves in extremely difficult measurement methods, refining the method, but at the end of the day, losing time. So my argument would be, we all know what kind of economic activities have an impact on the ecosystem. Concentrate on these activities and try to make them better. Torsten talked about activities on the ocean. We all know it, deforestation. But let's be honest, for the people from the West, if we look around, I'm from the Netherlands, also intensive agriculture is part of it. So there are many ways that we know what kind of activities have an adverse impact on ecosystems. And my call will be, and I discussed it also with Romain, simple penalizing rules for this kind of activity. So don't get lost as supervisor central bank in extremely difficult measurement methods and extremely difficult taxonomies. Try to bring it back to basics, and then be very clear about it. If you are not on the biological farming, but you are on the intensive farming where you have negative impact, then you get, for example, a concentration limit or a higher capital charge. So keep it simple, but be practical and get started. That's on the risk side. Now we come to the asset side, the allocation side, which is also more exciting. What is happening? If we look at the mandates of institutional investors, and Richard knows all about it as a credit rater, we are so used to the old asset classes, equities, bonds, and then we have a new thing, it's like commodities now for years, hedge funds, private equity, but land or the blue asset water is not an asset class. So it is not in the mandates of pension funds and insurance companies to invest in it. So it's just not yet in the thinking of the people. So I think what I would like to do today is to make a plea to recognize this as an asset class, land restoration, and there are many examples where degraded land, dead zones in the water like Erie, and the seas where you can restore them, and it takes like 20 years. Then the first reaction of a supervisor is, okay, these are illiquid assets because you cannot trade them, you invest in them and you stick with them for 20 years. Please don't say this is illiquid, so we need an increasingly high capital charge. That's the normal nature of looking at illiquid assets. Try to be innovative. And now the thinking leap is, if we look to the future, we know that the bio-adverse activities will get increasingly policy risk, higher capital charges, regulations. So these are the stranded assets of the future. These restoration assets are getting into the money because players in the market who need to improve the profile will be looking for these assets. Airline companies will be looking for land restoration because there's a nature-based carbon offset. So these kind of assets are also the assets of the future, and that can be very exciting, but it means broader thinking of the financial players to include it, and it requires regulators, central bankers to really get engaged and try to think how to get it into the regulatory framework, and looking beyond that it's illiquid and therefore difficult to value and therefore on high risk. So that's a big challenge. Then and basically it boils down to see the value of restoration activities, whether it is the ocean or land. So I ask for swapping places, put nature first, and look at the allocation function. And to help out, Romain and I are on a new study group of the network of screening the financial system on biodiversity, under the leadership of Mayun and Rick Robbins. And we are working hard, hoping to have our final report next year, also to how to tackle it. But my final word will be, look at it from an opportunity perspective, how we can restore nature. Thanks.
Thank you very much, Dirk. And since you mentioned it, indeed, this NGFS / Inspire working group will publish its first vision paper in the next few weeks. So you can keep an eye on that. Yeah. So let me close this second part, I would say, of this panel with more of a private sector perspective by turning to Richard Mattison, who's the CEO of S&P Global Trucost. So Richard, since Torsten and Dirk have already mentioned a lot of issues, including the question of complexity, with tipping points, what's the potential solution with regard to biodiversity loss from a financial perspective. Is there any point you would like to emphasize or to complete, or anything you would like to discuss so as to let us know how you see that from a private sector perspective, and how you think that these potentially systemic risks posed by biodiversity loss should be addressed?
Yeah, I mean, we believe that nature-related risk needs to be integrated into financial decision-making at many different levels. So the decision-making by, for example, companies in terms of how they're allocating capital and spending money, but also by portfolio managers, by banks, asset owners, and all the way through to retail investors. And so what we need is information flow up and down the investment and banking value chains. Of course, you need a specific set of information to manage biodiversity risk at a particular location, but you also need information to flow so that capital allocators can allocate capital to addressing some of the risks and to providing some of the solutions. So we think really there are 4 key challenges and 4 key opportunities. So the first challenge is, in general, there's a lack of understanding of the systemic risk associated with natural capital and biodiversity. Even using the word biodiversity can be confusing to the financial sector because they focus on a particular species, for example. And the Dasgupta review has been incredibly helpful as a framing report, I think, and there's more work that can be done on that. And I know that the great work of the NGFS and specific central banks is advancing the understanding. But I think so far we've had a real focus on either ESG or climate. And we think that, maybe you could address climate change by focusing on 2 sectors, energy and mobility, but you could also inadvertently turn a blind eye to the complete, destruction of nature, which would actually accelerate climate change via the food system, for example. So we would classify the food system as within the hard to abate sectors along with the others. So that's the first thing, is an understanding of the system-wide risk. The second thing is that biodiversity and degradation of ecosystems is actually very location-specific. And so therefore you need a location-specific understanding of that risk, of the opportunity. And that is pretty difficult to handle because when you're investing in a multinational company, they could have hundreds or thousands of different locations. And how do you actually, as an investor, understand opportunities and risks posed by natural capital in that context? So at S&P Global, we put a lot of work into understanding those linkages. We've actually mapped the locations of 110,000 companies to about 3 million, just under 3 million assets owned by those companies, and to the locations those assets are located in, so that we can understand some of the risk. So we focused so far on climate-related risks on the physical side, so looking at things like floods, droughts, rising sea levels, wildfires, but clearly these have an intersection with nature and biodiversity. And so we're extending that work to really understand how assets owned by companies and assets developed by companies in the future will impact on nature. We're also doing that from the perspective of supply chains. So how can you map commodities to supply chains to really understand the risk embedded in indirect impacts of companies? So that's really understanding the location-specific nature, and how do you aggregate that then to companies as entities and to portfolios for banks and asset managers and so on. Third key challenge is that there's a lack of consensus, we think, around the relevant and material metrics. So clearly, there's lots of metrics that might be relevant to you as a particular stakeholder, but financial institutions are interested in financial metrics, and at the moment they are lacking on natural capital by and large. Certainly the consensus is not quite there. So we think there needs to be more consensus. And also metrics at different layers. One of the lessons we learned from climate change is that what might be relevant at the project level may not be relevant at the portfolio level if you're an asset manager. So you've got to think about how metrics and information flows to those who can allocate capital. And we believe that there needs to be more work done on thinking about aggregatable metrics. Finally, the fourth challenge is really we have clarity on climate goals, such as portfolio temperature alignment for asset managers. Is my portfolio on track for a 1.5 degree trajectory? But we lack that clear view of what good looks like from a natural capital perspective, especially at different layers. So at the project layer, at the company layer, at the portfolio layer. So I think there are 4 opportunities. I think we could do more work on the quantification of the system risk in a similar vein to the Stern review. What percentage of GDP is at risk? 50% relies on biodiversity, but when you relate that to companies, for example, how does that look? And what percentage of GDP could be allocated to address some of these issues? I think there's plenty of work been done on a number of these things, but the framing is quite important for the financial sector in particular. The second point is we could actually think about a common platform for biodiversity and natural capital data. How do you link what is happening in the real world on natural capital destruction with companies and with portfolios and with various different financial sector activities? And perhaps there's a data set there that could be developed in collaboration. We think that there's a need to develop and agree a clear set of indicators that are relevant for the management of risk at a location level, but also relevant for the management of risk at a bank portfolio level, at an asset management portfolio level, and various other different layers as well. And finally, there's a huge opportunity to link, and the other speakers have mentioned this, to link the loss of ecosystems with the opportunity, the $100 billion opportunity to develop a voluntary carbon offsetting market to address climate change and to help organizations achieve their net zero ambitions. We need to link net zero to nature, in short. Thank you, Romain.
Thank you very much, Richard, and many thanks to the 3 of you for these very insightful responses that for the second segment of the panel. So we can now move to the last section of this panel, in which I would like to have my 2 remaining speakers reflect on the proposals that have been made so far. I would say within the broader context that would go beyond finance. So put simply, and I think that my next speaker, Geoffrey Thiele, who's professor of economics at Columbia Business School, will agree with me. We can say that biodiversity ecosystem services are public goods, that as such, they cannot be optimally delivered by the market, or at least that there is no reason why the market would deliver them in an optimal manner. And that requires regulations, not only on the financial side, but it would also require regulation on what we could call the real economy side. Although personally, I think I don't like to make this separation, but I will make it here for simplicity. So Geoffrey, my question is really building on your extensive work in environmental economics, and in particular, of course, on the economics of biodiversity. I'll put that a bit provocatively on purpose. Do you think that this growing interest on the links between biodiversity and finance is really worth it? Or do you think that the financial system basically would just follow that what needed would be regulation on the so-called real economy and that financial players would follow? Or how do you see these interactions basically between finance, economics, given your expertise and the economics of biodiversity?
Well, thanks for a challenging question. Very important question. As Elizabeth said, it's very important to solve the issue of biodiversity loss. So it's very attractive to use financial markets in this respect, because financial markets are enormously powerful. They have tremendous leverage in a lot of contexts. So obviously it's very tempting to see what one can do here. As you said, biodiversity, the services that biodiversity provides are essentially public goods, which means that they're services which are provided to everybody, whether they pay for them or not. And it's notoriously difficult to make money out of providing a service that people can use whether they pay for it or not, obviously. So that's the fundamental problem we've got here. The other big problem we've got here, of course, is that natural capital is generally not owned by anybody in particular. You know, ownership of natural capital, ownership of fish in the sea, for example, take Torsten's case, is ambiguous or non-existent in many ways. And markets are devices by which you transfer ownership from one person to another. And if ownership is not well defined legally, then it's very difficult to use markets in this context. So there is a need for a lot of intervention, regulation, as opposed to using markets, but it is also possible to use markets to some degree. And I think we have to be much more imaginative in working out how to use markets. I mean, the most obvious forms of intervention to conserve biodiversity are things like just protected areas. You know, we've got national parks, we've got in the oceans, we've got marine protected areas. And there's plenty of evidence that national parks and marine protected areas actually do stabilize biodiversity and indeed reverse biodiversity losses that have occurred already. They can even pay for themselves in some cases. I'm sure Torsten is aware. I mean, there are plenty of examples of marine protected areas in the oceans which actually pay for themselves in the sense that they increase fish populations. And these fish populations then spill over into adjacent fishing grounds. So ultimately, you know, the fishing in areas around these MPAs is enhanced by the presence of an MPA. So that's an example of which situation where an investment in biodiversity conservation actually pays off. There's some other examples actually in Africa of biodiversity conservation paying off. For example, there's been a lot of investment in conserving charismatic animals in southern Africa, in places like Namibia, Botswana, and so on, South Africa. And that's generated a lot of ecotourism. And if you look at the economics of this, you can see that the investment in biodiversity conservation of this form has actually paid quite a substantial return. And there's a lot of a country like Botswana and Namibia, a significant part of their export earnings comes from tourism. And that tourism is based almost entirely on nature and on the conservation of nature. So you can actually, you can calculate a good return on the investment in conservation of nature in cases like this. I'll give you an example of a rather different type of conservation investment which pays a return. There was a barrier island off the coast of South Carolina here in the US, which came up for sale a number of years ago. It was a beautiful island, completely unspoiled, but it had been zoned for development, economic development. The state and various conservation agencies bid for this, hoping to make it into a nature reserve, but they were outbid by a commercial developer. The island was zoned for building 5,000 homes, but the commercial developer in the end actually built 500 homes on a small part of the island, and then turned the rest of the island into a nature reserve. And he explained after he'd done this that this wasn't a charitable act on his part at all, that the value of the 500 homes that he built was enormously enhanced by the fact that they were embedded in a nature reserve, which was guaranteed to last forever. and that it actually was more profitable for him to turn part of the island into a nature reserve, and then you use this to enhance the price of a small number of homes than to build a large number of homes. So that's a case in economic terms of biodiversity being bundled with private goods and services, regular goods and services. So an investor in home building has sort of bundled the homes with biodiversity there and served the biodiversity to enhance the value of the homes. And there are actually quite a lot of examples of that type when you start looking for them. There's a more subtle form of this type of thing occurs when companies take the trouble to have their products certified as in some way biodiversity friendly. So if you can think of, lumber being certified as sustainable by the Forest Stewardship Council, or fish being certified as sustainably caught by the Marine Stewardship Council. What's happening there is that the companies that are taking the trouble to get the certification are really trying to persuade consumers that they're making a contribution towards biodiversity conservation. And they're bundling biodiversity conservation, if you like, with the private goods, the fish or the lumber or whatever that they're selling. So that that's also a way in principle of beginning to use a market and generate market-based incentives for conservation of biodiversity. Now, one of the most powerful of all the regulations used in the US has been the Endangered Species Act. Once a species is listed as endangered in the US, the Endangered Species Act makes it illegal to take any action which reduces its survival chances. And wolves, eagles, red-cockaded woodpeckers, all sorts of species really owe their existence in the US to this Endangered Species Act. And that actually has been modified to introduce a market in endangered species in certain cases. I haven't got time to go into the details now, but there's a mechanism for essentially, as soon as you put a constraint on people's ability to do things, you can generate a market in exemptions without constraint. That's essentially what a cap and trade system does. And essentially what the ESA has done in the US is introduce a kind of cap and trade system in biodiversity. And that puts a commercial price on biodiversity conservation. And that in turn generates an incentive to conserve biodiversity. Final thing I'll mention is just payment for ecosystem services. As many speakers have said, biodiversity provides a very valuable range of services. These services are definitely having a real economic value. And the question is, can the people who own the biodiversity or control the biodiversity extract payment for these services? And now, because some of the services are public good types of services, that can be difficult. But there certainly are examples where that's worked quite well. So the idea of, for example, paying people to grow forests or to conserve forests as a solution to climate change is in effect paying for an ecosystem service, because forests capture and store carbon dioxide. That's an important ecosystem service. And what we're trying to do when we pay people to keep their forests intact through something like the RED system is actually paying for an ecosystem service. That's an important, putting a valuable incentive on conserving forests, which are obviously a crucial element of biodiversity. So that's a case where climate change, something which is designed to solve the climate problem, can also make a contribution to solving the biodiversity conservation problem. I think I'm more or less out of time, so let me stop at that point, Romain.
Perfect. Thank you very much, Geoffrey, for providing us with this insight, I think, which really help us set the frame through which we can assess this interaction, I would say, between not only finance and economic sectors with regard to biodiversity, but also with their interaction with different regulations, such as the one you mentioned, endangered species, or the mechanism you could create, such as a payment for ecosystem services. And I will now ask our last speaker, Jim O'Neill, and thanks again, Jim, for being here today under these health circumstances that you're going through. So Jim is currently chair of the Chatham House and also a member of the WHO Europe Commission on Health and Sustainable Development, which may also have some insight to provide on this discussion, actually. So I know that in some of your work, Jim, you have been working on what I would call like even bigger ideas. I will mention just two of them here. One is really, it relates a little bit to what Dirk has been talking about earlier on, really the values through which financial players behave, how they act, and I really say values with the plural on purpose. And the second one is the question of new global institutions that would be required, that would be needed to take care of financing global public goods, such as biodiversity. So could you elaborate a little bit on this with this still in mind this interaction between finance and other institutional mechanisms that should be developed.
Well, thank you very much, Romain. It's a great pleasure and honor to be with you all, especially with the remarkably experienced and talented panel that you've put me on. I feel slightly embarrassed to be in such company, but let me try to be brief so there is time for Q&A before the session closes. And so I'll try to make just a few points with a bit of illustration to give some color over your provocation. So linked to what others have said, and obviously I speak as somebody that's spent as a full-time job. I stopped it 8 years ago, but as a full-time job over 30 years in professional finance. There was a lot of focus from others about risk, but it's, you know, finance, as many other forms of business, sort of driven by the perception of risk versus return. And the realities that I learned with the nature of global finance is that one extreme is always mass fear, and the other is mass greed. And where we are on the spectrum often is, of course, closely related to both conventional and unconventional bubbles. And both to change that, but linked to a crucial second point running through the theme of what everybody's touched on. If you want to make the private sector system show some responsibility for their own role in dealing with societal challenges, and thereby placing greater value on the context of the business they have direct experience and activity in, then you essentially have to change the set of risk versus rewards. A lot of my thinking about this has come from in my long history of responsibilities, more recent past of mine, when in 2015 I was asked to lead an independent review into global antimicrobial resistance. And a lot of people frequently think of that naturally as a challenge of excessive use of antibiotics in humans, which ultimately is why most of us are most concerned. But it's really at the core of why we need One Health across animals, plants, fish, and the whole of everything on Earth. And one of the things that I discovered in undertaking, well, I'll repeat the three big things that I discovered. First of all, we don't do something about this, the pandemic we're going through right now will end up in history seeing as a bit of a garden party. Because if we run out of effective antibiotics, then we're going to end up possibly having 10 million people a year dying by 2050. And today, on the back of COVID-19, 18 months later, it's 3.5 million. And so in that sense, this is a bit of a warm-up act, and suggests to me that in the spirit of never letting a crisis go to waste, we need to think systematically and what I'd often describe as profit with a greater purpose, as opposed to profit just for profit's sake, in the way we conduct our lives going forward. Second thing, going back to the AMR review and antibiotic resistance, and crucial to this specific discussion about biodiversity, in many, many parts of the world, the inappropriate use of antibiotics is much bigger in animals, plants, and the seas than they are in humans. Almost definitely including the two biggest economies in the world, China and the United States. And because of the interplay, and we see it with this pandemic we're facing, probably, as animals and humans and biodiversity challenges meet humans, we end up with the kind of problems we've got. And so we need to incentivize, we either need to incentivize the private sector system to change its own risk-reward calculations, or give the responsibility to those that provide services for public goods, much stronger abilities to impose a lower risk of those threatening all aspects of the future. And I have to say, for those that have talked briefly about changing risk capital ratios, it seems to me, as we go through time, this is an inevitable development. And I would hope, as it relates specifically to climate change, coming out of COP26 later this year, we may have the beginnings of a consensus that our central banks will be asked to consider mapping out a future where then that can become as normal a part of life, which in itself indirectly will change the rules of engagement of the financial system on its own risk-reward calculations. And in this sense, I'm highly influenced by something that often goes under-discussed, in my opinion, in the post-2008 environment, which, as you all know, because central bankers are at the core of it, was where the origins of the Financial Stability Board came about. And at least as of an hour ago, until I came on this call, even though we've had a lot of strange things going on in the world, including, as always, in finance, the global financial system has played a much better role in providing its service to ensure that there's sufficient capital around to do what society needs of it, rather than just what those that drive PE ratios in banks think. And in that regard, I'll say two last things very quickly, then stop. Going back to the AMR review, and I'm deliberately doing it this way so people ponder on it, our final report, that is where there was quite a lot of influence in the media from, at least, was we suggested there were 29 interventions necessary over a decade around the world to stop 10 million people dying by 2050 and a loss of $100 trillion of global GDP. And the investment needed to stop that was about $42 billion. To my astonishment, that amount, as big as it is, was less than the amount that just 3 US pharmaceutical companies had spent buying back their own shares as part of their supposedly efficient balance sheet management in the first half of the last decade. And there are many things that policymakers can do to simply change a shift in the risk-reward calculations in so many different sectors, including the rules of engagement for the use of share repurchases. But the final thing to say, and this has come directly from the very stimulating work of the Monti Commission, which I'm a proud member of, and was highlighted in our call to action, and our final report later this year will follow up with that. But we hope some of our influence will be coming through the G7 and the G20. Based on the good work of the Financial Stability Board, we have specifically recommended that now there needs to be a health stability board brought under the leadership of the G20, in order that we can stop this general view that the health departments in every country are somewhere over the other side of town and completely divorced from finance. Because until we do that, we're never going to solve these major reoccurring global health challenges. And more broadly, and we've discussed it at length, particularly because of the thoughts and leadership some others are playing on climate change.
I think if you could just conclude, Jim, I would appreciate it. Yeah.
Last comment. Ultimately, there should be a need for a public goods stability board under the G20, so that society in general, including the captains of business, don't just think of all these challenges as something that are external to their regular activities. So let me stop there and turn it back to you.
Thank you, Jim. So I really want to save some time to respond to some of the questions we received, and we have 16 minutes left. I understand we'll be kicked out after 16 minutes, so we'll have to be very smart. Still, I wanted to take advantage, so to speak, of Elizabeth Mrema's presence to give her some sort of concluding words. If you could do that very quickly, Elizabeth. Basically, I will put that very briefly in the interest of time. How does everything that has been said so far, could it fit within the COP15 and within the post-2020 global biodiversity framework?
Thank you very much. Just in simple words, I think all the panelists have underlined the importance of taking care or looking at nature as part and parcel of the financial operations in their different operations. Just as climate, nature is equally as important. 1, 2, clearly also what has been underlined, that the financial sector is now more and more moving away from just focusing on risks, but that there are opportunities, and really many opportunities on nature which give returns back to the expenditures. 3, I think there was also more or less an understanding that even these operations, it's important to look at the incentives being used to really create a net zero for nature in moving away from unsustainable financial operations in the different interactions or businesses. And 4, clearly, financial sector has a role to play as far as nature conservation, nature restoration is concerned. In that regard, then clearly the financial sector has a role to play both in the development of global post-2020 global biodiversity framework, but also its implementation once it is adopted. And with this then, really it means that we need now the financial sector to be engaged in the development process going on, so that these views then could be better heard by the parties who are negotiating. And as I said, those are the parties or governments which will need to create that enabling environment at different settings for the financial sector to be able to operate. Appropriate policies, appropriate regulations, and therefore that enabling environment. Probably I stop there. Thank you.
Thank you so much, Elizabeth, for putting that such interesting terms in such a short time frame. So we have about 12 minutes, I would say, for question. I will need to take 30 seconds to close the session. I've been checking the questions while you were speaking. I think there is one that is clearly asked by Stefano Battiston that is clearly for Dirk, which is really about given, I think you can see the question as well, Dirk, but basically, given the complexity related to biodiversity, how do you identify the activities that should be penalized, and what level of capital requirements, for instance, would you implement to penalize the exposure of financial institutions to these activities? There are other questions. There's one on disclosure, which relates to what Mark Carney said before, which we could not hear because we were preparing this session, joining this session already. But is disclosure enough? I would dare to say that based on what everyone said, it's not really, I think, what we've been saying so far. But feel free, perhaps I would suggest, for instance, that Richard and Torsten, you take that, but feel free, of course, to address other questions as well if you want. And there's also a question related to, can we build on climate-related risk tools to use them for biodiversity, basically without needing to reinvent the wheel? And there was a related question, which was, how do we assess the interactions between climate change and biodiversity loss in terms of risk? How do we work on them kind of like in silo, or do we reconcile them? And I would like to open that one perhaps to Jim and Geoffrey as well, but feel free to respond to other questions. It's just a proposal. There was a last one that was asked just a few minutes ago, which was perhaps a bit more related to what you will discuss there, but other people may be interested as well in responding to them, which is how could central banks integrate biodiversity into their collateral framework and or within their asset purchase program, such as quantitative easing QE. So Dirk, maybe given your work, you may be interested in addressing this one. So let me start perhaps with you, Dirk, since there was a question directly for you, and we can Torsten, Geoffrey, and Jim. And please try, we have 10 minutes left, so if you could like really in 1 minute, 1 minute and a half max.
Yeah, thank you. So the question is, how can we move to complexity to identify activities? Cambridge Institute, they published a report earlier this year on biodiversity, and they identified 6 causes of biodiversity loss. And I don't have them at hand, but for example, a big one is land use and land use change. We all know deforestation, and we can apply the same, I'm looking at Torsten, to the ocean. And for example, land use change, we go to urbanization. I mentioned farming, so intensive farming where you degrade the soil. So that would be the level of identification. And then if you finance these activities, then Jim already said it, then you could apply a higher capital charge for that. And equally, you could apply a lower capital charge, for example, if you do the other one. So if you do biological farming or we do the restoration, rather than looking at illiquidity of the assets you look, this is an asset which in the future offers a nature-based solution also for carbon offsets. So it is rather looking at activity level, looking at the causes of biodiversity loss, rather than going into the detail and measure exactly, because you have many tipping points which you cannot measure with static methods. And there I stop to leave time for the others.
Richard, if you want to go ahead in 1 minute.
I think so. I think the point was around is disclosure enough. I think disclosure is required, frankly, for us to have better information. I don't think we have the right level of information flowing through the financial system to make good judgments on the financial impact of biodiversity and natural capital loss. So we do certainly need disclosure. This is actually good because it's a topic of note globally anyway. The IFRS are looking at ESG disclosure standards. You have Europe, 50,000 companies now have to produce better sustainability information than they have ever done before. The SEC is looking at disclosure requirements for US. So this is timely. We need to introduce nature-related disclosures to the debate. Just one point on climate-related risk tools. We've got a lot of climate-related risk tools and scenario tools that we have at S&P Global. And I do think that some of those tools can be applied in the context of nature-related risk. Looking at the risk of climate change to an asset in a particular location, you can also layer on biodiversity and natural capital type risks. So for example, a beverage company had to shut down its operations in Brazil because of a huge drought near Sao Paulo, caused by deforestation in the Amazon. So linking loss of natural capital to location-specific risk, which may not be in the same location, to asset value and license to operate and other types of financial risks is critical, and we're certainly working on that. Thank you.
Could I add something there, Romain?
Sure, you can respond now, and we'll then turn to Torsten.
I think of a point that Dirk made.
We have time for Elizabeth at the very end, but unless if there's anything you would want to add at the end.
Dirk mentioned land use change as a sort of point in common. And I think it's very important. I mean, land use change is important in the context of climate. It's also important in the case of biodiversity loss. So that's another area where these risks coincide. I mean, obviously deforestation is a major driver of both climate change and biodiversity loss. Farming, intensive agriculture can be harmful to both again, and development, certain types of development. Now, farmland is an increasingly popular asset class among certain types of investors, as of course is property. And so, I mean, that's an area where you could possibly, those are asset classes which exist, they're liquid asset classes. It's an area where you could think of some kind of loading connected to biodiversity costs of the asset class. We really would like to sort of provide incentives for changing the structure of farming so it's less impactful in terms of both climate and in terms of biodiversity. So that's just a quick thought, sort of elaborating on Dirk's point there.
And if Roman allows me 1 second.
At the end, if we have time, because we really need
new land use, then
20 seconds.
Lower returns. We have lower returns because you invest in the future. So investors have to get used to lower returns to this new assets.
Okay. Important points about the values again, which which returns you expect. Torsten, 1 minute, Jim, 1 minute. So that's
Sure.
I can close, or Elizabeth if she has anything to add based on what I said.
I think there is a great opportunity of using these positive interactions. So the additional cost, if I can put it that way, to include a nature-based wetland solution in a port development is actually, if I integrate the biodiversity component, maybe slightly higher than just thinking of mitigation, but the benefits in terms of resilience is so significantly higher that it is definitely a worthwhile investment. So that understanding of how those integrate and give the economic incentives in that direction is what is so massive. And so just to close with Geoffrey's point, if you do the same thing with a marine protected area plan that is strictly conserving and takes the climate components into account, again, you get these multiple benefits, a massive economic incentive. So what we need to now create is the revenue incentives and the investment incentives so that those integrated solutions and opportunities get implemented.
Thanks.
Well, 2 points very quickly. Listen, it took the 2008 crisis for the IMF to realize that financial stability was macro relevant. And given their central place in life, given what we are going through, they are almost definitely now going to start regarding analysis of health systems, possibly not conducted by them, as something they've got to focus on because it's macro relevant. And it's the same thing more broadly. Second thing to follow it up, just as Richard made reference to my good friend Nick Steen, he influenced me on how I approach the whole AMR review. If you can demonstrate that if we don't do something, you're going to be losing 10 million people a year and $100 trillion worth of future potential growth, and it's only 42 billion is required. That is a Warren Buffett-esque style 20,000% return on capital. That's what we're talking about. It's not rocket science.
Thank you, Jim. Elizabeth, any breakthrough that you could present in 30 seconds, or you want to leave it there as you want?
Yes, 1 word or 2 sentences. I would like to echo one of the panelists who had indicated there's still lack of awareness of the opportunities available on nature or biodiversity. So I would really urge then the financial sector to look at these opportunities. And I think Torsten had just mentioned, Geoffrey, the land use, which is one of the major causes of biodiversity loss. I will add the food systems. And this is where also bigger percentage of financial resources go. So can we think positive and yet still get the return? So I think all of us need to create that awareness, put the guidance, the principles to guide the financial sector to be able to operate. And I hope the task force on nature-related financial risks about to be launched, hopefully will provide some of these guidance tools to help moving forward. Thank you very much.
Thank you, Elizabeth. I understand we will be kicked out in a few seconds, so I won't get into summarizing the whole this incredible session. But let me really warmly thank the 6 of you. That was incredibly interesting. So thank you so much for being here today and for your insights. I'm being told by the organizers that you should return to all the participants to the BIS website or the YouTube streams to follow the upcoming guest speeches by Robert Engel and Al Gore. which I guess will not be available in the platform then, I'm not sure, but go to the YouTube links or BIS website. With this being said, thank you so much. I regret I don't have time to summarize everything, and sorry for interrupting you. I think I've done it very equally. Thank you and bye.